Hello and welcome to Principles of Accounting, Chapter 2. So we're on Chapter 2. Now remember, the things that you learned in Chapter 1, we still need those things because all of this is going to build on itself. Okay. So as we go through these chapters, you have to keep remembering what was in the previous chapter because it is the foundation for the next chapter. Okay. And this is a really, really important chapter that you really need to focus on to be able to get the next two chapters in. Okay. So we are going to start learning about debits and credits, but let's look at our very first objective that we have here to explain accounts as they relate to the accounting equation and describe some common accounts. Okay, so we have this accounting equation. We talked about this in chapter 1. You can abbreviate it. I will abbreviate it. Assets equal, sorry about that, put plus owner's equity. I say owner's equity because we're not talking about a corporation just yet. We are talking about a sole proprietorship. We try to baby step us into that corporations. We'll pick up on corporations in principles of accounting too. Okay. So there's lots of different accounts that fall underneath these headings. Okay. So we're going to go through a couple of them. They have some assets here for us. Okay. Cash. When they say cash and we're making journal entries here for cash, we really are talking about a checking account or a bank account, not really cash. I know that can get a little bit confusing sometimes, but we just, for teaching purposes, we just call it cash. Okay. Accounts receivable. This is when we have had a customer buy stuff from us and we extended credit to them. So we didn't get the cash yet, but we got a promise for them to pay us cash in the future. Okay. There's also a notes receivable. Now, here thing to really remember is there is never going to be an interest associated with an accounts receivable. There will be interest associated with a notes receivable. Okay, so that kind of defines the two. Accounts receivable, we're extending credit, but we're not charging any interest. So that's usually going to be very, very short term. Okay, notes receivable, this could be short term or long term. Okay, it could go out 5, 10 years. Okay, so there is going to be an interest element to a notes receivable. It is a written promise that a customer will pay a fixed amount of money and interest by a certain date. Okay. So the next thing we're going to talk about prepaid expenses, and they throw office supplies underneath there. They're just a tiny bit different than the prepaids. They are a prepaid expense. When we buy office supplies, we don't have an expense, and this gets a lot of students confused. When we buy the office supplies, we put them in the supply cabinet. They haven't been used yet. They're not an expense until they get used. And so when I'm in the teaching classroom teaching, I have a podium up there so you can pretend that podium that I'm standing at is my supply closet. Okay, I buy the supplies, I put the supplies in that little closet. They're not an expense until they are used up, taken out of the supply closet and then used. Okay, prepaid rent and prepaid insurance. Sometimes we'll prepay these so we can get a discount on them. That's the only reason we would want to pay those early. Okay, land. Um, you can buy land and a building together, but we are going to keep them separate on our financial statements because we will actually depreciate a building, but we will not depreciate land. Okay. So I always kind of use the building there at CBC, the Watkins building. If you think about a tornado came through and blew the building down, the land is still underneath there, is still good. Okay, so land doesn't get depreciated ever. There are a few cases that went to the Supreme Court that they got away with depreciating land. Those are going to be things like a toxic waste dump. Um, they call it Baby Diaper Mountain out there in Sherwood, those two big waste management mountains of trash. That land's not going to be good for anything else ever. So they could get by with depreciating land. Okay. Um, Equipment, furniture, and fixtures. These are all the other little things that equipment could be computer equipment, furniture could be the chairs we're sitting in the classroom, the tables we use. The podium itself has a very complicated computer system inside of that. That is also equipment. Okay. And those are also depreciated. Building and equipment, furniture and fixtures are depreciated, but land is not. And we will talk a little bit more about depreciation in the next chapter. Okay. So now we're moving over to the other side of the accounting equation. I'm going to write it out again. We're right here. We're looking at liabilities. Okay. Accounts receivable is the opposite of accounts payable is the opposite of accounts receivable. Okay. This is where another business has extended credit to us. Okay. So remember, anything that has a payable at the end of it, it's always a liability. And the receivable, if it's receivable at the end of it, it will be an asset. Okay. Just like notes receivable, notes payable will have an interest element to it. Accounts payable will never have an interest element to it. Okay. We have some accrued liabilities. We could have taxes payable, rent payable, salaries payable, any of those that we owe sometime in the future, we're going to record that. Okay. Here's one of the hardest ones for students to get, this unearned revenue. Okay. So I always use the example. I long time ago did taxes. And so if somebody in the classroom, one of y'all came up to me and said, Miss Solano, you're really, really smart. Will you do my tax return for me this year? And I'm going to give you $100 right now to do my tax return in the spring. I'm going to take that $100, put it in my pocket. I'm going to make a journal entry for it because I got cash, but I did not earn revenue yet. Okay. That $100 would go on my books as unearned revenue. The prefix UN makes this a liability. Okay. We cannot record revenue until we actually perform the service. So I may perform the service in the next year. This is going to be a liability on my financial statements. I don't necessarily owe $100 back to the customer. I owe $100 of services or goods to the customer. Okay. So even the best accounting students will get this wrong once or twice. Okay. But that little prefix means it is a liability. Okay. Equity accounts, I'm not really a fan of them throwing revenues and expenses underneath equity. If you kind of think about equity as the umbrella, revenues and expenses, they have their own financial statement. Yes, they're not really equity accounts, but they just fall underneath the umbrella of the equity. Okay. So the owner's capital, this is where the owner put money in. The owner withdraws, that's where the owner takes money out. So if this was my little business, those accounts would be called H Solano Capital. That'd be where I put money in. And H Solano withdrawals. Okay, so we don't have to put Heather. We can just put the first initial, and that would be those accounts. Okay, we're dealing with just a sole proprietorship, so we're only going to have two of those. We're not going to look at partnerships, but think about if we had a partnership, I had a 50-50 partner, that partner would also have their own capital and their own withdrawal account. Okay. So revenues and expenses have their own financial statements. So I kind of want you to think of them as separate. Okay. We could have lots of different revenues. Most of the time, we're only going to have one or two. We could have a service revenue. We could have some extra office building that we're not using right now. We could rent that out to make just a little bit of money, and that would be rent revenue. We have lots of expenses, though. If you think about your own personal finances, you might only have one or two streams of income coming in, maybe one job, two jobs, mom and dad helping you out just a little bit. But you may have lots of expenses. You may have rent, you may have water, utilities, telephone, you have all those expenses. So even a business will have a lot of different expenses. So they could be renting a building and have rent expense. And yes, they could have rent revenue and rent expense. Okay. So We have salaries expense, utilities expense, anything with expense at the end of it is going to be in that expense category. Okay, there's a couple of accounts that may not have expense at the end of them. We'll get to those in a couple of chapters and I'll point those out to you. Okay, so we have what's called a chart of accounts. This is our ledger. The ledger is going to hold all these accounts and all of their balances. Okay, the chart of accounts is just like what this picture is right here. It's just an account number and the asset. When I was working as a bookkeeper, some of these I would have memorized, mainly because cash, I was always making entries into cash in or out in accounts payable. So I had some of those memorized, but some of these I didn't. So we actually had printed out a chart of accounts and I had it like right there close to our desk. Me and my boss would share it. That way we could find those account numbers really fast. Okay, so this is just a chart of accounts, just has the number and the account. That's it. No other information is in there. Okay, the ledger is going to have some of that deep information that we are going to need. Okay. There's data analytics is in every profession right now. Most it is been in accounting for a very long time. We have a student who just graduated last year who is going to do their master's not in accounting but in data analytics, and like that's going to be a great pair of degrees because they're going to understand the accounting world and they're going to understand data analytics. Okay. So, chart of accounts can be used, process transactions, analyze accounting data, compare it from one year to another, identify errors, and track any changes in accounts. So, there's a lot of things that can be done now with data analytics in accounting. All right, I will see y'all in the next video.